of the things about our show is it's going to be unique.
You are what you do. You can say any amount of things that you want to say, but what you do is what everybody sees.
People are like, oh, I'm just going to JV it. Like, it's just JV it. Like, what the hell is that mean?
I cannot tell you how excited I am to hang out with you guys today, so thank you so much.
Well, then that end buyer could come back and say, well, I didn't fully understand that it was subject to.
That's not a thing. Like, the SEC has thought of all of these things. They've been here since 1932.
And you can do what you want with your property.
Buyers have time, they have negotiating power, they have options.
Oh my gosh, I am blown away by your inexperience, and they've been in business 20 years.
And that includes things other people put on your property, right? It's your property to be okay. Suddenly, Cousin Jimmy's in a lawsuit.
A novation is replacing one contract or one obligation with another.
Out with the old, in with the new.
Yes.
Hey, everybody, welcome to the show. Today, our topic is pitfalls for the passive real estate investor. I'm Andy Fowler, and I'm here with Sean St. Clair. If you're new to the channel, make sure to follow us on YouTube, Facebook, or X, formerly known as Twitter. You can find us at the handle @InRem Podcast. That's @InRem Podcast. Also, you can download an audio version of the podcast. You can find it on Apple. You can find it on Spotify or any of the major podcast platforms. With that, I'm going to turn it over to Sean, who has our legal update.
Thank you, Andy. So my legal update today is a follow-up on last week's discussion on agreements for sale, contract for deed, but we're taking a step further. Now we're asking, how can you convey a property subject to an agreement for sale or contract for deed? So you've entered into a real estate transaction and you've acquired an interest in the property by an agreement for sale and contract for deed. And as we discussed last week, that gives you basically all ownership rights to the property except for title. Title still remains in the seller. And so, well, now you want to convey that property. What do you do? Well, there's always the traditional method. You could find a buyer, and then the buyer's purchase price and either their financing or cash that they're going to bring to the table is more than enough to pay off the amounts owed under that agreement for sale. And then you, as the original purchaser, you're allowed to basically, or you're entitled to the difference between the payoff to the seller and the end buyer's purchase price, and just sell it traditionally. But what if you want to sell it on terms, right? You want to sell it so that end buyer is then responsible for paying or monthly, and so you're gonna basically be the lender. Well, what do you do in that case? In that case, what you're going to do is you are going to you have two options. One is if your agreement for sale originally had an assignment provision that allows you as the purchaser to assign the agreement for sale, you can then assign the agreement for sale. Or if the agreement for sale doesn't have the right to assign, but does not have a due on sale clause or due on transfer or due on alienation and doesn't prohibit subsequent agreements for sale, you could do a subsequent agreement for sale. So if you're going to assign it, what you would do is you would execute an assignment of the agreement for sale. It's like a one-page document, and you're going to assign it. And then from there, you will record a notice of assignment of agreement for sale, and then you will execute a warranty deed from you to the assignee. So to the end buyer, you'll execute a warranty deed, and hopefully you have a servicer in place, a loan servicer, or you will then deliver that original warranty deed to the loan servicer, so that when that assignee performs under the agreement for sale by paying all amounts that are owed, by paying off the agreement, then the servicer will record the original warranty deed from the seller to you, the initial purchaser, and then the secondary warranty deed from you, the initial purchaser, to the end buyer, and then they're going to have title to the property. So that's the assignment method. The other method is an agreement for another agreement for sale. It's very similar, except you're going to actually have an agreement for sale document that then allows you certain rights to, forfeit the subsequent purchaser's interest in the property under that agreement for sale. And then you're going to record that secondary agreement for sale. And then you're going to execute a warranty deed from you as the original purchaser to the purchaser under the agreement, the new agreement for sale. And you're going to deliver that warranty deed to the loan servicer, so that when that secondary purchaser performs under your agreement for sale, which basically wraps the original agreement for sale, when they perform under that subsequent agreement for sale, then the first servicer records the warranty deed, and then from the seller to you as the original purchaser, and then from you as the seller to the end purchaser, so that once again, title's put in the name of the purchaser. So there's a process here for that. And, but you cannot, and this is important because I've had plenty of clients who have tried this, and some of them who have done it and created title issues and real messes. But you cannot convey the property. If you're a purchaser under an original agreement for sale, you cannot convey the property on terms via a warranty deed and a seller carryback promissory note and deed of trust, because you do not have title. So you do not have the ability to execute a warranty deed. You do not have the ability to deed the property to an end buyer. You do not have the ability to take a deed of trust back, because once again, there is no title transfer in an agreement for sale. So you don't technically have the right to title, and you don't have a right to convey title. And so if you do that, you're going to just create major title issues. You have to either assign the agreement for sale, or you have to do a subsequent agreement for sale. Next week, I'm going to follow up on this, and I'm actually going to talk about loans and financing by a purchaser under an agreement for sale, because you cannot do it just the traditional way. And we're going to talk about that. But as far as how to convey a property subject to an agreement for sale, you can do the traditional method, so long as the buyer is going to bring cash to the table sufficient to pay off all of the other underlying obligations, including the amounts owed under the original agreement for sale. You can assign the agreement for sale if the agreement for sale allows for it, or you can do a subsequent agreement for sale as long as that's not restricted by the original agreement for sale.
All right. Thank you, Sean. That whole problem sounds like it should be this next year's surprise bar exam question. I think I'm going to need to rewind that. All right. Thank you for that. All right. Let's talk about updates coming up for the NREM podcast. Every Tuesday, 3:00 p.m., we host the Creative Finance Collective. What is that? That is a collection of attorneys and professionals in the space of real estate and creative finance. There's not a lot of them. There's 8 to 10 that we've kind of identified throughout the country. We get together for an hour and we talk all things creative finance, what different jurisdictions are doing it, how they're treating, what laws are being changed with respect to creative finance, how different lawyers are approaching the transaction. But what it really provides to you, the listener, is an opportunity to have professionals in that space captive for an hour, and we take questions for the entire hour or until we stop getting questions. So it's important for you, if you have questions, to participate and engage with the lawyers in the space. We're there to answer questions about creative finance. Again, that's every Tuesday, 3:00 p.m. Arizona time. Make sure to join us. We'll be doing it again this afternoon. Also, today, or for today's episode, if you have any questions, we're going to try to take questions in the final 15 minutes. So post it into the chat. If you've got questions for us or for our guests regarding today's topic, we're happy to try to address those. Post them in the chat as you think about them so you don't forget about it. You don't have to wait till the final 15 minutes. We're monitoring the chat. We'll be prepared for that. All right, so our topic today is pitfalls for the passive real estate investor. And on occasion, we've gotten into topics. The show is a show for real estate investors. And we talk about all things around the law that apply to them, but on occasion they get into deals that apply to maybe we're talking about syndications, or we're talking about securities and areas that are unique or call into respect other areas of the law. So with us to discuss this topic, passive real estate investor, is Aleksey Chernobelskiy. Aleksey, I know I just butchered your last name, but in having spoken with you, I know that you'll forgive me. Thanks so much for being with us.
Thanks for having me. You did a good job.
No, all right. So I know. Let's give our listeners a little bit of an idea about what you do. Tell us about your background and what your business is in advising LPs.
Yeah, sure. So as far as, first of all, thanks again for having me on. As far as background, my most recent background was I left a public REIT at the REIT, which stands for Real Estate Investment Trust, for those folks that don't know. The REIT was called Store Capital, STORE. Used to be publicly traded, but now it's private. I ran two teams there, the portfolio management team, which managed roughly 2,800 buildings, give or take, by the time I left, which was about 10.5 billion in like invested principal. And I also ran the underwriting team, which looked at any new transactions that came in. And, typically we had somewhere between 10 to 20 deals in the shop any given week. And so I managed that whole process, that whole team that sort of had to figure out risk reward on any given deal and figure out what I like to call pink flags, and if there are enough of them to pass. So that's what I did before. Had several other experiences prior to that on the buy side. Now I run my own place. It's just me. It's pretty simple. I started it about 6 months ago, so it's actually fairly new. I advise existing limited partners on existing transactions. I would say probably 80% of those are real estate, but I've had a decent amount of requests from people in the VC space and typical like lower middle market syndications as well. And I'll also help people think through future investments as well. So there's really two parts of the business. One is investors needing help on something they have already invested in, and then investors needing help on something they're thinking about investing in.
Now you also run a Substack, is that right?
Yeah. And the idea behind that was, I get to see a lot through, all of the requests that come in. And I couldn't find the great information out there for investors. And the goal of the entire thing was I'm literally speaking to someone, for example, that lost 500 grand on a syndication. So step one is obviously helping that person, making sure that they're in the best place that they can be. Step two in my mind is I obviously don't want to mention the person. I also don't mention the GP's name because I don't want to get into that. But to the extent that I can anonymize the story and share it publicly, even if it helps one person avoid a similar mistake, I think it's very helpful. And so the Substack is actually literally called LP investing lessons. And I essentially just share things that I see over and over again, right? And unsurprisingly, the similar mistakes tend to repeat themselves. And I try to remind people.
So talk to us about, because a lot of the folks that might be watching today maybe are real estate investors, but they're new to the idea of entering the passive investment space or entering as a limited partner. How do you typically find, I guess another way to put this is, how do limited partners traditionally enter the space? Is it they've come into money and they've successfully run a business, they don't just want to do it anymore? Maybe they inherited money from a family. Is it kind of just a mix of people that you see?
Sure. So I'm hearing two separate questions. I'll try to address them separately. So first, I think is, how does one start thinking about LP investing? That's one. And two is, once you actually want to do it, what do you do next? So the first question is actually pretty complex, because I think, for what it's worth, I mean, this is obviously just my opinion, so people can ignore it. But I think, based on what I've seen, a lot the way that I would summarize the current retail LP marketplace, um, I think a lot of people that shouldn't have gotten into syndications got into them, and a lot of people that should be in syndications haven't gotten into them, right? And so I think that's actually really interesting on both sides, right? And the reason why I say that directionally is because the best passive investments start in a very active way in the beginning. It takes a lot of time to do diligence. Before you're able to do diligence, you need to understand what to look for, right? And the average person, I would say, at least in the retail world, that got into these over the past like 2 years, didn't really know how to do diligence. And now I'm getting some of those calls with regrets and whatnot. Of course, there's also plenty of really good stories too of people that have, you know, doubled and tripled their money. But there, I think there's always a question of, did you double or triple your money because you made a good risk-adjusted bet, right? And you knew what you were going into going in, or did you get lucky? And of course, there's always like a portion of luck. Anytime you can't predict everything, but I think those two are very different in nature. So again, so going back to questions, you know, how does one decide whether they should or shouldn't? I think that's a very complicated like portfolio allocation question. I can very comfortably say publicly that if you don't have time to learn how to invest passively, and or you don't have time to vet deals because you shouldn't invest in every single one, you probably shouldn't be investing as an LP. Like that's just the fact that I really don't mind saying. Now, once, let's say you have both, you have some education, you have some time on your hands, let's say, you enjoy sort of like the picking apart deals, talking to GPs, getting to know them. I think it's very healthy and good. At that point, the question is, you know, how do you get in front of GPs? How do you find them? How do you vet them? What allocation looks like that's healthy? Because you don't want to overexpose yourself to a given asset class. You also don't want to expose yourself to a given GP. You know, like I've heard from people that have put, you know, 50% of their savings into one GP, and it might be across 10 deals, but now all 10 deals are going bad. You know, of course, obviously, you know, hindsight is 2020, but diversification is a good thing.
So, Aleksey, let's start, and we'll get into a lot of kind of what you're talking about, but let's start really at the ground floor for somebody just learning about what this looks like. What do we mean, and how do you define a passive investment? What should the listener understand that to mean?
Yeah. So, put it very simply, if someone wants to invest in the real estate market, which kind of just to be clear, I think that skips over the portfolio allocation question. I always like to say this. It's not clear that you should want exposure to real estate in the beginning. Okay. But assuming you've thought about that and you decide that you do, and assuming that it's a healthy percent of your net worth, which is another big topic, you know, at that point, there's essentially three ways that you can participate in the real estate world. One is, you know, you can buy like a residential property, let's say, down the block, right? And you put, you know, 5 to 20% down, depending on if you want to pay, you know, PMI, et cetera, right? So that's one. A second one is public REITs, such as the one that I used to work for. There's a ton of publicly traded companies, and there's also index funds of those publicly traded companies or ETFs that essentially provide like a very diversified play for a platform that, let's say, you want to access multifamily. You know, so there's I don't know exactly the number, but certainly more than 10 public real estate investment trusts that focus on multifamily. Some of them are larger, Some of them focus on like more affordable housing. Some of them focus more on like, the fancier markets, let's call it, and Class A buildings. And that's sort of, a big strategy question of like what you feel passionate about and how much risk you want to take on, and etc. The third way, which is where I spend most of my time, is private syndications. In a private syndication, there's two parties. There's a general partner and a limited partner. The easiest way to think about it is the GP is the one that's doing the vast majority of the work, from finding the transaction to closing on it, to executing the actual strategy and selling it. And then there's the limited partner who puts up the majority of the cash, typically 90%, 95% at times. And they are silent in nature. So, like once you invested, you essentially have no say, which is why the due diligence in the beginning, as I said earlier, is very active. In other words, very good passive investments are very active in the beginning.
So you've used the term, limited partner, general partner. Let's say I want to invest passively, and I want to place my money somewhere, and I've maybe come across or networked with a general partner who I think would be good to work with, good to fund the whatever project they have. Where should I place my money? Like, how should the entity structure be set up? Should it be a corporation, a limited liability company, a limited partnership? What's your recommendation as far as, where does my money end up? Where does it land?
Yeah. So I think you're kind of asking two things. First, I just want to clarify. Investing in a REIT, for example, is pretty passive too. Right. And I would say in some ways it's actually more passive, because all else equal, and this is a topic we could spend 20 minutes on alone, but the diligence that you need to do as a share owner in a public REIT, by and large, is less than the diligence you need to do when you're allocating to a single asset. Right. And so because of that, I think, if people sort of assume like if I want passive investing, the only place to go is syndications. And I just think it's important to like clarify that that's not the only place. It's just the only place where you can get tax benefits, one, which, by the way, don't apply to everyone. That's a whole other topic too. But also, it sort of allows you to access a single asset as opposed to a portfolio, which can be good if you really bet well and you did your diligence, or it can be really bad because if something goes wrong, there's zero diversification across other assets like a REIT would provide, or perhaps a fund would provide. In terms of structuring, I think I might be misunderstanding your question, but I think that's more of a question for the GP. In other words, how does the GP set up the structure? The LPs typically, will invest out of a trust. Sometimes it's an irrevocable trust. Sometimes they just invest directly. Sometimes they invest through an LLC. And I'm not an attorney, so I think generally speaking, the liability of an LP is by definition pretty low because it's an LP, and your downside is kind of measured by losing all your money. Now, one thing I will note up front is many people get into these things, or I should say got into these, thinking the downside is losing their money. So two things there. First, many of them originally thought that wasn't even an option. In other words, they get into them thinking the worst thing that can possibly happen is they'll just get their money back because it's an asset. And like, if something goes wrong, you can just sell it. But of course, that's not, again, happy to talk about that in detail, but like, that's just not how it works. And I've written about it for anyone who wants to see. And secondly, deeper than that, is the fact that not only can you sell at a loss and lose your money, or potentially all of your money, you might even get a capital call. And a lot of that is happening now, where the property more or less, or the partnership, you can call it, ran out of money. and there's all capital calls aren't created equal, but there's a decent chunk of them that essentially are in the state of where the equity is totally wiped out, and you either put up more money to have a chance at getting some money back, or you go to foreclosure and lose everything. And those are massive surprises to a lot of the retail LPs that I speak to. They just didn't realize that, like what do you mean you need more money? Like, I gave you money, the debt brought in money, you gave us a pitch, like, what's a capital call? Yeah.
Well, let me follow up then and just ask. I understand what you're saying as far as the general partner is the one that generally is going to structure it. But if you were, and maybe it doesn't matter to you, but if you were analyzing an investment and it, a syndication, for example, and the money was going to land, or the property, the real estate was going to be owned by a corporation, by an LLC, by a limited partnership, or maybe joint ownership amongst the, investors, so that they own it directly. Of those four, is there one that you prefer or would like to see, or does that not even really factor into your analysis as far as the quality of the investment?
To be candid, I don't get that deep, and I'll explain. Meaning, there's levels to diligence, right? And I think the majority of it, I sort of offer 3 different packages to LPs that need help. The beginning one is just the basic package, which is like, what risks may I be missing going into this? By and large, I think 75% of the time you can sort of weed out situations where the risk reward balance doesn't make sense, and that can be for 3 different pillars that I sort of described in depth. One is execution, the other one is alignment of interest between the GP and LP, and the third one is actually the property itself. I rarely touch legal issues unless they are directly, unless there's like a business decision to be made, if that makes sense. And that's just because I don't feel like I'm an expert in that world. But obviously another side question to what you're asking is like, how much does this matter? For example, if you're putting up $5,000, right, versus $1 million, right? And so, and obviously, should you talk to a legal counsel in each of those cases, right? And so obviously, the more that you're investing, the more the legal bill sort of starts to make sense. But typically, right or wrong, I think a lot of these things are kind of an autopilot in a sense, from a structuring perspective. But the pitfalls tend to, from my experience at least, the pitfalls tend to be not in structuring legally, but rather the terms, like the business terms, like fair terms between GP and LP, like fair risk reward balances, like how much is the GP putting up as a co-invest, like things like that, that are kind of like they're not determined anywhere, right? So it's you can do whatever you want. It's the Wild West in a sense.
So is it fair to say then, when you use the term, because Sean and I are not on the investor side, we're on the lawyer side. So when we hear general partner or limited partner, we hear a particular entity structure. When you're using the term limited partner, it sounds like you're using that more broadly, in the sense we're talking about a passive investor, regardless of what you might call that within the particular entity structure. So if it was an LLC, they'd be, a member, or if it was some sort of shareholder in the corporation, you're just kind of using that term to generally refer to passive investor.
Yeah, and from a structuring perspective, I mean, the most, maybe this was, perhaps this was your question, Sean. Like the typical structure is that there's a GP entity, there's an LP entity, right? And then those two invest into another LLC that is the owner of the building and the borrower of the loan. Like that's sort of like the most basic structure. And of course, like in funds, it gets more complicated at times, and et cetera, et cetera. But that's like, 75% of cases.
Now, Aleksey, you mentioned your three pillars for real estate investments or for LP real estate investments, and the first one you mentioned was execution. We want to talk with you about all the pillars, but starting with that one, talk to us about what you mean by execution, and does execution include this initial process that you were just referring to of the due diligence and the work that needs to go into for due diligence?
Sure. So first, I'll just note that there's three pillars, and I organized them in that way for a reason. Contrary to what most people think, when you look at a property investment, in my opinion, at least for what that's worth, the property itself, which is sort of like what you're investing in, actually comes third in my analysis personally. And so now going back to your question, what is execution? In my mind, it's simply, does the GP that you're investing in have the ability and the track record to execute on whatever they're promising, right? And so like, I think you kind of felt out some of the things that I mentioned, but like part of it is, do they have a track record? How much of that track record was done by them versus them at a prior firm, let's say? Are there a bunch of GPs together? And perhaps there's questions about like who's actually making decisions among them, right? And in difficult situations, I've certainly seen that sort of not go well. And beyond that, there's like, do you trust them? Yeah, very basic things like, have you done a Google search? Like, have they been party to pretty serious lawsuits? Have they been indicted by SEC? Like, I wish I was joking, but like many times this sort of gets uncovered after the fact.
Mm-hmm.
But and by the way, like that's not to say that the hardest part about investing is like, no single factor will tell you like invest or don't invest. And that goes both ways. Like some people ask me like, what's one thing you would ask for to determine if something is a good investment? And usually my answer is, you should stop what you're doing and not invest with that mentality. In both directions. In other words, no question can give you a positive enough signal to invest, and no question can give you a negative enough signal to not invest. And we can go through some of those examples, but let's say on execution, since that was your question, let's say you find that the sponsor has no track record, like this is their first deal, right? So someone might say, oh, well, that's crazy, pass. And I would tell them like, you're not an investor, right? Because when you see that, you just should be like, okay, like I need to consider that in the grand scheme of the investment. In other words, comparing this to another deal, there is additional execution risk, because I don't know if what this person is saying they're capable of, they'll actually be able to achieve. And by the way, that's true with someone who has 40 years of experience too. Like not everything can be executed to the T always. There's always that risk. But the point is that risk is a little bit higher. And so you, as an LP, need to be compensated more for taking on that additional risk, right? And that's true about anything. I mean, you can sort of like ask any question, and there's two sides to it. And as an investor, you need to be able to synthesize everything. And at the end of the day, come to a conclusion based on a balance. Like, is this risk reward worth it, or it feels off?
How deep do you recommend diving into the, let's say it's just one GP? What type of deep dive do you recommend, or how deep do you recommend that you go? I mean, do you want to see their personal financials? Do you want to see their creditworthiness? Do you want to analyze all of that, or is it a little bit more surface level than that?
So I think generally speaking, asking for personal financial statements or financial statements of the GP is probably not market. Unless you're investing, a huge chunk of the LP stack, which is like, the investable equity, so to speak, and you're taking 50% of it with one slug of cash, so to speak, personally. it's very rare in syndications that's a question. Sometimes it's asked verbally. Now, having said that, I think you're bringing out a bigger point, which is important, which is that people sometimes forget that, and by people I mean LPs. Like LPs tend to forget that this is a business, right? And the GP is a pretty risky business, right? It's a business that's driven by fees and promotes, and outside of fees and promotes, it's a negative cash flow business. And so because of that, the health of the GP is actually really important. It's just not market to ask for something as a result of, $100K investment, right? And same with personal financials, right? Like, similar to my comment before, on the one hand, if someone is like very wealthy, you might argue that, if something goes wrong, perhaps they'll have the ability to right the ship because they have the personal capital and they don't want to deal with like lawsuits and whatever. You could also argue the opposite, which is someone who is like literally brand new, 25 years old, but they have this like deep hunger to succeed, will outwork the other person, right? And so I think the balance is important. Now, one thing I'll just quickly highlight, and obviously happy to dive in deeper, but I think a lot of LPs that I speak to are scared to ask questions, right? In other words, going back to your point, like if you feel like for whatever reason, and I can name a few reasons, if the PFS plays a critical part in your investment decision for whatever reason, ask. Like just because it's not market, ask. And that applies to really any question that you feel is important. I think some LPs get stuck in this mindset of I don't want to bother the GP. The GP is so busy. I'm just one guy. And all of that is true. Like, but look, listen. Worst case scenario is you're not able to make the investment decision because they didn't get back to you. And I'll tell you, this isn't always the case, but I would say at least half the time, if they don't respond to you, there's probably that in and of itself sometimes is a good answer, an indicator. And so there's a balance, of course. You don't want to be the guy that sends like 100 questions on every deal, right? But also you have to understand that as you're getting to know someone for the first time, like you're getting to know them for the first time, and like, just like with marriage, hopefully, like there's a process to that, and understanding, your partner. This is pretty similar because you're putting up your cash and you're entrusting this person with your capital. And once you wire that money, like you will have basically zero say in what happens next.
Right. Well, and that is the reason why I asked that question, as far as like how, deep do you want to go into, the GP? Because more times than I can count, I've had clients who have come to me or to our firm where they've, either made loans or other passive investments only to find out, and, I guess we could call it a Ponzi scheme, but basically they were taking the money from that project to try to save the other project in the hopes that they'll have another project to save that project. Right. And so, it makes me think, well, if the GP was more financially stable and had, the resources to basically, handle all of this and wasn't relying upon, basically having a new project every time to fund an old project because they were undercapitalized, they didn't have the financial resources themselves, those issues may not have happened. How do you guard against that particular thing? Because everything looks good, like a Ponzi scheme, everything looks good until it doesn't. And then the last person to invest is stuck holding the bag, right? Or the last few to invest. How do you guard against something like that?
I mean, look, I've looked at dozens and dozens of capital calls, or spoken to people that have lost all their money. I think situations where everything looked good in the beginning are very rare. I would say it's 1 out of 10. right? Maybe it might even be less. In
Mhm.
other words, if you look at the original deck that people invested through, you can pretty clearly see signs of things that needed to be clarified, signs of things that are not market for that level of experience, or maybe the whole strategy doesn't make sense in the context of what they've done before. Um, Real estate investing is not easy. Like, people tend to sort of make it seem very simple. And by the way, that I should say that the beauty of it is that when you zoom out, the business models actually tend to be pretty simple, right? There's like equity and debt, more or less, um, and there's an entry price and an exit price, right? And some cash flow in between, hopefully.
Mhm.
So like if you zoom out, it's a pretty simple business model that's very attractive, but people don't realize that the nitty gritty of execution on that business plan is extremely complex.
Mhm.
Now, you mentioned a little bit ago, you compared this to a marriage. And one of the things that I think of with a successful marriage is an alignment of interests, right? The idea that you have a similar direction as to where you want to go, a similar belief system as to how things are going to play out. And that's an important feature. Now, that's one of your pillars as well, an alignment of interest. Explain that to us and how that fits within syndications and how an LP needs to be thinking about that.
Sure. So as you said, you're going into a partnership, marriage, whatever you want to call it. It kind of is, like in a funny way, it's almost like a marriage.
Mhm.
You just, it's a marriage where you can't say anything, which is, I guess, a type of marriage. But um, well, in terms of thinking about alignment of interest between GPs and LPs, first you have to understand that there's no standard, right? Like, there's no such thing as a template, and everyone has to go by that. GPs can offer whatever they want, and to the extent that they raise the money on that, like, you know, the market speaks, so to speak, right? So you can't really tell people, hey, your fees are over market, and the person might say, so what? Like, I've done this for 30 years. I can charge higher than market fees. Um, and I get oversubscribed within a day of publishing a deal because people know me and I've deserved that. And I would say that person is right. Right. Now, all else equal, right? Like, if you just unwind that, I think alignment of interest comes in a few forms. And one of that is the co-invest. In other words, how much is the GP putting up personally, net of the acquisition fee, right? Because the acquisition fee sort of is paid by the LPs, and it's well deserved, and that's a whole other topic, and it's an important part of the syndication process. But the question is, how much net are they putting up after the acquisition fee into the deal from their personal money? The thought process being, if you have your personal capital at stake, and hopefully it's a meaningful amount to you personally, um, you'll take care of it a little bit better, right? So that's alignment of interest. Another alignment of interest is um, the structure, like the waterfall, the fees, right? In other words, if things go right, how do the outcomes look for the parties? Typically, like, those are pretty easy to understand. But the more difficult and complex question is, what if things go wrong? Like, if things go wrong, who benefits in the situation? Right? And that's very important to think about up front, because as an LP, you're putting up the majority of the cash. So, like, you have way more capital at stake and at risk. You have zero control over it, right? And so there's a trust component. But if things are turning the wrong way, like, you need to make sure up front, before you invest, to understand what happens in those circumstances.
So with the execution and the alignment, I know we'll talk about property and you can talk about why you place that last. Is this process, and I know this probably is really all part of when you use the term before due diligence, your due diligence into the deal as a whole. Is this something kind of from start to finish you will commonly work with and consult with on investors, ideally on the front end of this deal to help them analyze it?
Yeah, I mean, I quite literally go through the 3 pillars, and give people feedback on each one.
So talk to us about the property. So explain to us why you've ordered the pillars this way and why the properties last.
Sure. So I think the reason why it's not first is because you don't have control. In other words, if you're buying your own residential property, and you have your own vision, I mean, you can do whatever you want. Like that's up to you. Your execution is in your hands. You don't have to call anyone, right? And here it's quite the opposite. In other words, you're entrusting someone else with your money. Not only that, but like midway through, they might never respond to you again. They might stop answering your questions, right? And it gets pretty frustrating if things go south. So because of that, the underlying property is important, but I think when analyzing sort of like risk reward, the first thing before you like get to location and valuations and the business plan is like, who am I giving this money to? That's one, right? Like execution, like who are these people? Do I trust them? Do they have the track record? If they don't, again, like just something to consider within the broader context. Um, and secondly, once I get some feedback on the first idea, the second is okay, like I can get comfortable with them executing on this. But like what happens if things go south? How is each party being compensated throughout the process? Are the fees too high? Is the waterfall too rich for one party? Right. So that's important too. And then third is the property, which is simply, how do I figure out how whether this is actually a good investment, right? But notice, so in a somewhat funny way, like that's kind of last. Like many times you can weed out, I would say probably 60% of deals just looking at 1 and 2, and you have barely looked at the property because I guess what I'm fundamentally saying in summary is there are great GPs who have really bad properties, right? But there are a lot more not so great GPs that may have a good property or a bad property. It almost doesn't matter because at that point, there's a question of you might have a not so great GP with a good property, but they still mess it up, right? And I would say great GPs buying not so good properties is much more rare.
Do you find, I could see a scenario where an inexperienced LP would place outsized importance on the property? And I think that might be kind of where you're going because they see that as the deal, right? Like, okay, this is a win. This is a no way kind of lose, and they kind of just skip past 1 and 2. Is that a problem that you see or a pitfall that you see?
100%. I mean, it's not just a pitfall. I think it's probably 90% of LP diligence. They'll look at the property and, ask some basic questions about the property, and they're like, oh, okay, interesting. Sounds good. Here's 500 grand. But they kind of skip over like who is executing on that strategy. Do they have a good background to actually do this? Are we aligned, from a fees and waterfall, et cetera, and co-invest perspective, right? Yeah, I mean, they just tend to skip over that. And I think, for what it's worth, I think a lot of that is based on not knowing the impact of those things. For example, fees, I think most people think of fees in, who cares? Like, I'm just paying a fee in order to be in this deal. but I'm going to make it 2x. Well, the reality of fees, which are very normal and standard to a degree, right? But I've seen, like 2x and 5x of normal, is that LPs need to realize that day one, before they even when they wire the cash, they're down somewhere between 15 to 30%, sometimes more, on their investment. In other words, if I wire $1 million into syndication, that million at investment is now worth 750, let's say. And so that's okay, but I better believe that I can get back to $1 million, right? That's question A. But obviously, if you're taking an immediate loss, you better believe that you can get a return on that as well. And real estate investments, by nature, aren't meant to be high multiple outcomes. Or if someone wants to YOLO, so to speak, into an investment, there's plenty of things that can potentially make you 10x, 100x. Generally, real estate is not the place for that, right? And because of that, on the downside, that also means that you need to be very protective of not losing any money. And I for whatever reason, I have not seen that to be the case. LPs tend to think real estate is safe. You can't really lose money, but they forget that that depends on the operator, depends on the capital structure, depends on the environment, and it's actually quite easy to lose money in real estate if you don't do it right.
Well, let's say an LP does their due diligence on the execution and alignment. They feel good, everything looks good, and now they get to the property. What are some things that they should be looking for as to the property to make sure that they're comfortable with the investment?
Said it simply, I think a lot of it deals with the assumptions, right? You'll typically get a pro forma of what I like to call a pro forma of a pro forma, which is the reason why I have that joke is the way this works is you typically get diligence docs from the seller. Some of those may not be right, but sometimes the buyer will make assumptions on wrong seller docs. So in other words, the seller docs are a pro forma in a sense because they're not fully accurate. And then the buyer will make assumptions on that, which is a pro forma on a pro forma, right? And somehow as an LP, you have to look at that and be like, okay, is this right? Do these margins make sense? What assumptions are you making in terms of growing income? Are you assuming that expenses will drop, right? Property values, generally speaking, are determined by two things: NOI, net operating income, which is kind of the cash flow that the property is producing, or at least a proxy for it, and then the cap rate. So the cap rate, by and large, is completely not in the control of you as the LP or the GP. But the NOI is, you could say, in some sense, it's controllable. In another sense, a lot of it is determined by market forces, like rents can change at any point, construction costs can change at any point, labor pools might change, right? So in a sense, it's market driven, but you can have quite a bit of impact on NOI if you have a good strategy. So the biggest thing, Sean, is making sure that you understand the business plan and you vet it. And then beyond that, it's what does the capital structure look like? Is there floating rate debt? What does the maturities look like? What's the risk in terms of other capital providers in the deal? Am I buying this on an expensive basis? In other words, what do comps look like today in terms of rents and price? And also, what am I selling it for? One of the probably one of the biggest misses from an LP's perspective is not catching cap rate compression, which is basically if you keep NOI flat, you don't change it over the course of 5 years, let's say, but in 5 years you meaning you had a plan to increase NOI and it's all going to be great, but 5 years later the NOI is the same as when you bought the property. In other words, you kind of failed, but that's okay. because cap rates move down. And so then all of a sudden you sell the property and you 2x everyone's money, right? So that has how do I say this? I mean, that what I just described played out a lot, between like 2018 and 2022. And I would say probably half of the people that made money not because the GP was successful in their strategy, but because the GP happened to hold long enough and happened to sell at a time when interest rates were basically zero, right? But again, that's, to me at least, that's luck. I mean, meaning obviously you have to be in the deal in order to participate, and you took on the risk. I get it, but like going into that transaction, no one could have predicted that cap rates would be where they are at that time, and so on a risk adjusted basis, those bets actually made no sense.
Now, is that a factor that you'll analyze into a GP's history on a newer deal, even deals
Yeah.
that might have looked on the surface like, hey, everybody made money?
Sure. And I mean, that's part of the track record, in my opinion, is like, I'll just give you an example. Let's say someone bought something in 2007 and they sold it 5 years later and made it 2x, right? And contrast that with someone bought something in 2019 and sold it in 2021 for a 2x. To me, those are very different 2x's, right? In other words, and obviously there's questions about like what asset, et cetera, et cetera. But the point I'm trying to make is like multiples and returns are not created equal, right? Like, and in some cases, like for example, if you bought multifamily in like 2019 and sold it in 2021, it was like nearly impossible to lose money. In fact, it was almost like nearly impossible to not 1.5x the money, right? And so there's a question of like, of course you did a 2x, right? And sometimes if you ask the GP for like the NOI pre and post, at acquisition versus when you sold it, like the story I gave you, like sometimes it's unchanged, and which essentially means, they kind of got lucky on rates, and you could say maybe that was part of their strategy, but then you're a macroeconomist at that point, not a real estate investor,
So and this kind of gets into what I talked about before, as far as the deep dive into the due diligence on the property. How far down are you wanting that LP to go? And once again, I'll a real life story. I mean, I've had clients who passively invested in a project where it was vacant land, but then it was going to be developed. And they closed on it. They invested in the LLC. The LLC purchased the property. They thought they had enough for their development, and only to realize there was an environmental issue. And so they then tried to raise additional capital to remediate, but they couldn't raise enough. And project done. Everybody loses money. It's over. Done. Didn't even really get it off the ground. And the GP, I know who the GP was, not a bad person, has done other successful projects, but the property was bad. Everything else was good, but the property was bad, and somebody didn't catch it on the due diligence side. How much due diligence should an LP do to avoid that type of situation?
Look, I think it starts with a high level expectation. So, I mean, what you just described is one of, if not the most speculative part of real estate, right? In other words, it's very different to buy an existing building and find a new tenant. Or actually, let's start. Least speculative is you buy an existing building that's like 100% occupied on a piece of debt, and you cash flow the thing, right? There, you could argue it's probably pretty hard to make high returns, right? But also the risk is lower, all else equal. Then you sort of go to like, hey, I'm going to buy a building. The tenant, is going to vacate in a year, but I think I can relet it at a higher rent number, and therefore I'm going to add a lot of value, but I'm willing to take on that risk. Well, you just added risk, but hopefully you did enough diligence to add reward. And And what you described is like sort of like the opposite side of that spectrum, which is I'm going to buy a piece of land, entitle it, make sure there's no issues. And I think the first step for an LP is like, which part of the spectrum are you investing in, right? Meaning just the simple realization that like this is a risky deal is, I think, greater than 50% of LPs immediately, right? Before you even start diligence, like regardless of the GP, based on the property business plan, how risky is this investment, right? And obviously, what I always say is there's really nothing wrong with taking on risk as long as you know that you're taking it, right? And that's actually sort of the goal of my business in many ways. Is I never tell people whether they should invest or not invest. My goal is just to help them frame a better picture of the risks and the rewards, at least to the extent that I can see them, before going into something.
Well, Aleksey, we really appreciate you taking the time and educating us and our listeners on the risk to LPs when they're facing real estate investments. Tell our listeners how they can connect with you. Where is the best place online to find you?
Yeah, sure. My name is pretty unique. I most often I post on either LinkedIn or Twitter. I typically post 3 to 6 times a day, which all comes from sort of like existing work that I'm working on. And I also write twice a week at lplessons.substack.com, where as of this morning at least there was I think 2950 investors, 2,900 in other words, and yeah, that has grown pretty nicely, and it's been amazing to see it grow. Thanks for having me on.
Yeah, thanks so much for being with us. Look forward to doing it with you again.
Awesome. Thank you, guys.
All right, with that, everybody, that is our show. Make sure to join us for the Creative Finance Collective. We'll see you next week.
Have a good day, everyone.